The Hedgeless Horseman here. It's December the 20th, 2022. Uh, Pretty, let's say exciting noise today. Silver's ripping, gold ripping, a lot of stuff is ripping. I think nickel is ripping. Well, it was up around 7% earlier, I think. It's down to respectable, almost 3% plus. Again, pretty much noise. I mean, yesterday I think metals were down, all of a sudden they're up. You can basically just assume for your own sake, like, okay, if they're up today, they're gonna be down tomorrow, and I'm not gonna be surprised. And let's be honest, like if something is up 4.73% like silver, if it goes down 1% tomorrow, 1.5, that's still up over 2 days. It's like when I see people see some junior share up 20% on a day, and the next day it's down 6%, and people are pissed about it. It's like, hey, that's a very, very good 2 day return. And if it would compound at, let's say, plus 5% every other day for a whole year, you would be up 25,000%. And it's like, what's interesting, I've shown this many times before. I've not been needing to do as many cope videos, I guess, recently, because we're off the lows. I mean, Bear Creek Mining is already up, or was up 200%. We're here right now. From the bottom tick up 200%. I mean, that alone is like, a few years worth of gains. And it's not the only one that's up like 200% from the bottom. It's like, just proves my point. I mean, this is like playing Pong. They crash, they go up a lot. They crash, they go up a lot. It crashed and went up 200%. And if it would, to reach this, that would be like 800% from the bottom. And even if it's down, I don't know how much it's down from the actual top. Let's say, what's that like? I don't know, 20%, whatever. Let's say 3 week return here, or 4 week return, is still 124%, which is like a couple years worth of good gains. But it also shows, I mean, this is, in my opinion, still early. This is where I think it's time to get out of pure beta plays, especially. Obviously, this was like the best time ever to buy beta plays, and that's why they're all of a sudden up 200% from the lows. And of course, the shorts looked horrible. Everybody was talking about the risks. There were no prices that were low enough because there's always risk, etc., etc. But that's just how it is. Everybody's focusing on risks when it's super cheap and everything is priced in, and it just, if somebody sneezes at a stock, it can go up 100%. Because there's no, I mean, at some point you literally run out of sellers who's willing to sell at those prices. But if we're in the game of guessing the price tomorrow, which everyone is, you're not going to be buying here. If you're in the game of guessing where if price is going to be up or down within 2 years, you would be buying non-stop at a level like this, which happens, comes around every 8 years or something. But hopefully I won't be needing to do these copium videos. At least because all of a sudden people are actually, kind of bullish on miners because they see that, hey, these can go up as well. But as always, there's going to be more people buying lately than a month ago. Because that's how it is. Again, almost nobody makes money in this sector. And just to touch on volatility, GDXJ had a rebalancing. I think it was last week, or might have been finished last week on Friday, I think. And you see stuff like this. Minorum Gold up 65%, Bear Creek up almost 40%, Kootenay 30%, New Pacific 20%, yada yada. That's just an index inclusion. And here you have, like, the following day, let's say Monday. Some juniors almost gave everything back. Of course, I mean, I think a lot of people were buying with GDXJ when they went up like this. But what actually happened? Nothing happened for the companies, and this is just proves a point how absurd this sector really is. Uh, these are, if you could compound at these rates per year, that's superb. The market averages is 8 to 9% per year. Some did several years worth of gains in one day without anything changes, anything changing. It's just a fund buying or a fund selling, let's say. I mean, this is the volatility that people should really pay attention to. Again, it's like, what happens if, Bear Creek ripped? Okay, it ripped to here. More people will be buying because they see what has happened. But I think we should be thinking about, hey, okay, price went up, but Bear Creek didn't change this much in value. So if we're up here, all of a sudden there is, let's say, less probable gains ahead. Maybe 197% from 300% just, or 400% just, X weeks ago. So I mean, the risk reward dramatically decreased when this went up on no news. Here down here, a lot of stuff are no-brainers. Then they become less no-brainers, and it's like, personally, let's say you have some units that were not included in the GDXJ, and all of a sudden you have pops like this. Obviously, you got some gains, risk reward decreases, while let's say some other juniors were neutral or actually down. Then you could, like, okay, risk reward has decreased here because nothing has changed for the values of these companies. The target price hasn't changed, the price has changed. So we have less future returns expected after pops like this. Then you could reshuffle, sell that, and buy something that was down, let's say. Most people are happy buying this action, but the next day they won't buy because they're down. The short-term immediate trend is down all of a sudden, and then they don't want to buy. Shout out to Don Durrett. And it's like, it's kind of fun, or not funny. It's like Brixton, which is in the hodl portfolio, and I own quite a bit, has been down 23% on absolutely no news. Okay, no news at all, nothing has changed, so the price goes down, but the long-term case is intact, yada yada, and one might speculate that if there's even more good news, they might hold that off until we get into the new year, past the tax loss selling season. I think that is, and I tweeted about that the other day. It's like, not only will you see asks and sell orders all of a sudden disappear in 2023 when we're past the tax loss artificial selling silly season. I think there's quite a few companies who are reluctant to release news during this period, especially if it's good news, because they know it will not get rewarded. So again, fast forward just a week, 2 weeks. There's a bunch of selling pressure that's going to go down, so it's going to be less resistance to the upside. And I think some have saved up good news for that time period. So I think January is going to be quite a bit of good news in some companies where sellers have also disappeared. And that's why you're front running that by buying when the selling pressure is still there, where you can buy a lot of shares at very cheap valuations, because people are selling stuff they shouldn't be selling because they do it from tax loss reasons. Obviously an opportunity. It's like I was a bit pissed actually. I had a bid in for Brixton yesterday, simply again because absolutely nothing has changed for the case. Price went down, and it's like, okay, maybe they'll wait and announce some good news in the new year, etc. So I was ready to buy more because it also hit some kind of, let's say, this level here, which, support, let's say. And lo and behold, it's like, yeah, they have good news out today. drills 262 meters of 1.04 grams per ton, including 75 yada yada yada. So yeah, okay, it's a bulk target, a huge bulk target, but one of their many projects, and they recently put out some good news from their language projects as well. Uh, anyway, that's again this like I'm trying to train people to like volatility is the best currency we have because this volatility affects future expected returns. Down here, Bear Creek Mining might have 800% expected return. Up here, it might have 300%. Years worth of gains in difference just from the changing price action in a month. Huge implications for your future returns, expected returns. And of course, everybody's focused on the past. We're supposed to be focused on a future that is farther away than the market cares about right now. Let's say 1-2 years from now. In my case, or in this case, I expect again we're gonna hit this level and maybe beyond that one day. If it will be Bear Creek Mining per se, I don't know. But sure, I mean they were kind of close to I think bankruptcy not long ago, and then Equinox postponed their. I think they bought a mine from the Mercedes mine from Equinox, and they postponed the payment requirement. That's good and all, but that's not why you shouldn't be. It's like, yes, it's easy. I didn't hold any shares of Bear Creek Mining, okay? I didn't participate in this exact, even though yeah, I think I own for a bit, let's say, but this is a proxy. I much rather buy high quality companies. And on that note, I think it's very important to know yourself. I know that I get very uncomfortable if I own something that I know is a trading sardine. Very uncomfortable. If it goes up, I get FOMO. Because like, okay, now the herd is in, and now it's go time, yada. As soon as it goes down, I feel like, maybe this is a false top. So when I don't have any conviction in a case, because I don't see any material value creation, let's say I wouldn't want to own the company over 5 years, because in this case, if you own Bear Creek Mining over 5 years, who knows if you're gonna be in the negative or in the positive. I mean, if you buy here, yeah, maybe you'll be up. If you buy here, maybe you'll be down, etc. I like value creators, where the trend is at least up, and then it has 50% retracement along the way, as we've seen in pretty much every 10 bagger has multiple 50% corrections, but the trend is at least up. So I know that about myself. That's why I don't dare to buy trading sardines, because when I don't have conviction, I have a hard time buying when it's cheap. I am much more likely to FOMO, like silver, especially let's say mediocre quality silver juniors. But I have no problem buying lower, or not a big problem buying a totally intact case, above quality case when it goes down. It's like I've talked about Magna Mining relentlessly, and they recently, Doc Jones did an interview on Twitter Spaces with the CEO Jason Jessup, and it's like, unfortunately that was not recorded, and I missed parts of it. But it's like, yeah, okay, when you hear Jason Jessup, who ran mines for FNX Mining and is the CEO of Magna Mining, he's the one of the absolutely largest shareholders in the company. He's talking about a vision. He wants to build a multi-billion-dollar success in Magna Mining, and the market cap right now is 110 million. Over 50 million tons of nickel, PGM, copper resources. Insanely undervalued, still insanely undervalued. I mean, this should easily be a $2 stock. I think it's at $0.74 per share. That's just one of the best examples, I think, of how easy it is if you have patience and a longer term perspective. Because if the market agreed with me, we would not be lower than $2 right now. So I see a huge discrepancy between price and value, and especially price versus long-term value, because these are value creators. So if I think the fair value of Magna Mining right now might be $2 per share, and that's like not expensive even, I think. In 2 years, that fair value might be $7, $8, stuff like that. And you don't need a lot of those, obviously. So it's just have a longer term perspective than the market, and look at current price should be valued at, especially if they're a value creator, at relative to future value, because nobody sees that right now. Everybody's focused on the short term picture. Everybody's focused on the next catalyst, but if you're focused on the next 10 to 20 catalysts, which might, happen one day when the future becomes the present. So you care about stuff that people will care about later. That's how you front run, the short term focus of investors, basically. And it's, I guess, to sum up, this volatility we're seeing here, that's nice. Again, if nothing has changed for a case and it becomes cheaper, if you liked it at one share price, you like it even more at the next, and also at a lower price. And one thing I just thought about, which I've been thinking about, is the fact that, I watched a bunch of Warren Buffett videos and Charlie Munger videos and read Howard Marks books, at least one book, and Monish Pabrai, I watched a lot of his talks. The interesting thing about the mining sector, or any cyclical sector really, is that there are no real books per se you can read. I think Bob Moriarty's book, Nobody Knows Anything, is about as close as you can get in terms of tangible advice. Basically that, it goes, a cyclical sector goes up and down, and nobody knows anything. And you should just, buy when it's cheap, sell when it's pricey. In Warren Buffett's case, he's obviously value investor, etc. The difference is obviously that in a typical company, you don't have depleting resources typically. That's what you have in this sector. All mining companies are eating up their own future. Microsoft can't create as many Windows 11s as they want because it's just software, obviously. So you don't have that problem. Also, you don't have the sentiment swings as we have in this sector. So it's like there's not one book that will, I think, completely prepare you for this sector. Basically, and I think that's where the edge is, that you have to basically become self-taught in a sense. So I apply stuff or think about stuff like from a value perspective, but I also am keenly aware of just how swingy this sector is. Because the broader stock market doesn't have swings like this. You can make a lot of money just on trading sardines if you have timing. That's much harder in a blue chip company, let's say. So you have to really be aware, I think, about, and even a growth company will have huge swings when we reach these lows and these tops. And you have outperformance, let's say from this point to here, maybe, if you're down 30% or 40% in a stock, that's outperformance relative to most juniors. So like if you're down here and your portfolio from this point is down like 50% on average, that is outperformance. because when it turns, typically from this level to here, it's probably going to go up more than 100%. So that's not really a problem, but that is not something that many know about unless they have experienced this sector. Because in the broader stock market, if you're down 50% in your entire portfolio, I mean S&P takes some time to return 100% from the S&P because it averages 8 to 9% per year. Obviously more from the bottom in the next 5 years, for example. So you obviously have that sentiment swing there as well. We've seen the 2008-9 crash. After that, obviously returns were much higher in the next 5 years, and from the COVID flash crash bottom, returns were higher in the short term. But you really have to become self-taught, I think, and just apply a bunch of different, let's say, strategies, or have different concepts in mind. Because again, the sentiment alone affects the short to especially the medium term returns so much that you have to be keenly aware, I think, where we are in the sector. And if you're a value investor, that becomes automatic. I mean, if something is dirt cheap right now or back here, you obviously didn't need or shouldn't need this chart to like, yeah, this is a buy spot. I mean, it should be readily obvious. And yeah, I think, I mean, it's kind of hard to explain, but I do really think, again, that you have to become self-taught because there's so much noise out there. And if 5% of people beat the average stock market, I think it's even less who actually make any money over the long term in this sector because it is so volatile. And like I've said before, this chart says nothing about the short term. Okay, let's say here you should sell here. That didn't stop it from going up for between November for 4 months. It went higher and higher and higher. It's just that gravity will catch up, and a beach ball that is already low here, lower, months of downtrending action before poof. Same here. I mean, this sector was cheap here. It was cheap here. That didn't stop it from going down for this is a year of additional downtrending action. But as you can see, okay, it's not a big return, but that's like what, 22% in a year if you just bought this low and sold this let's say medium term high or short term high. That's still 22% per year, and more than double what the market average is. So if you bought here, down here everybody would say that this guy was a clown for buying here, but the guys who said that didn't buy this low. I think they might have bought here. So this guy still has a lower average, let's say, if he bought here than the guy that bought here, but now it's much easier to buy because we've seen an uptrend. And all this person had to do was really just buy lower, because if he got his average down to, let's say, from here to here, maybe an average here, that's 77% return in 1 year. All he had to do was look very wrong for a year before having a very, very good return over a 1 year period. If you can compound at 77% per year, you're going to be very rich. But that's what it takes. You have to look, in my opinion, you have to be okay looking incredibly wrong for an extended period of time, yet still having the conviction to know that what goes down will come up and what goes up will come down. And if you reach extremes like the cheapest level in 8 years, if you're not buying that, I don't know how you're going to make any money in the long term. And you don't need, I mean, all the times, like people sell out here after this downtrend because they want to time a bottom. let's say, I mean, this is a extremely strong move here, obviously. So let's say you're like, yeah, now I'm sure that this was the bottom. So now you buy in, and all of a sudden, immediately you're down like, I don't know how much is this, 30% in a week. How good does that look? If you have a expected return of minus 30% every 1 week, I mean you'll go down to zero before uh, uh, almost down to zero for like next in the next 3 months. Uh, so, but it's just how it is that people are reluctant to buy here, but much more willing to buy here. But the person who made the most when we hit this was the one who saw that, hey, this sector is real cheap, so he starts buying here. Looks wrong, keeps on buying, keeps on buying, keeps on buying, lowers his average, and when we're up here again, he might be, who knows, all in, and all of a sudden it's like a very good return. While some other person's like, yeah, I'm buying in here, have a quick pop, and down he's like immediately in the red. While this guy who just averaged down, he's still in the green if his average is down here. So it's like you get the margin of safety and the extra upside by simply buying cheaper and cheaper and cheaper and cheaper and cheaper and cheaper. And that's why it's like when I saw Brixton down on again, no news. It just become the risk reward just become a bit better. I'm much more willing to buy Brixton here than here if no news has come out. Because if you have a base case scenario, yeah, I think it's going to be this much in I don't know 6 months or whatever. Obviously, the returns are lower here than down here. I mean that's a huge discrepancy. That's like years worth of gains. I mean 50%, again, that's my goal for a year, and those are pretty ambitious returns to compound at 50%. So just this action here between December the 6th to December the 21st, or what is that, 16th or 16th, 10 days. This might have added on another year of really solid returns. Again, volatility. Use the price volatility. That's our currency, especially if you're all in like me. If something is up 200% on no news, nothing has changed for the case, the target price you have in mind is still the same, that means that the future expected returns are going down a lot. If another stock is going down while another one has gone up, maybe those returns are supercharged. It's like, yeah, okay, let's say you have Brixton here, you have an identical Brixton, if that's even possible. Or let's say you started here. Okay, Brixton goes up to 30 cents. I mean, these are not huge changes, obviously. But you have another stock that's down here. Okay, so you you're up 17%. Future expected returns in this stock, because again, no news, we're assuming no news, that's 57% within a year, let's say. But another stock that had no news, also has no news out, and you think it's a similar case, that's down in price. So the expected returns are 100. That's more than double. So I mean, in that case, you could sell, take profits in Brixton, buy the Brixton version 2 that's down instead of up, and all of a sudden you first of all got 17% in returns, 17% in returns, so you add 70% in dry powder, and you switch that to buy the thing that's going to go up 100% instead of 50%. I mean, that's compounding. That's real-time compounding, future compounding. We can't see it yet, but that's how you can create a lot of that's how you can beat this market. And volatility is the single thing you use. So that's what I'm talking about. I mean, imagine or think about how much opportunity to sell and buy has happened just in the last 3 trading days. You could have taken profits without anything changing for the cases. Price went up, risk reward went down. Let's say there were some other stocks, not necessarily the ones that went up, but that are down or neutral. They have nothing changed in those cases. Maybe the expected returns of those are, let's say, 300% over the next 2 years. And you get 65% in paper profits in a day in Minor and Gold. Maybe the expected return of Minor and Gold went down to 100% over the next 2 years. So then you use that upside volatility with no change in the case, price change, so the current price to future expected value changed. So you got your paper returns, and the gap to fair value decreased a lot, so the risk reward became worse, and then you buy something that is went down or sideways, or nothing changed, which has, let's say, 200 to 300% future expected returns. Nothing changed for the portfolio in that very moment, from selling, let's say, Minor and Gold to buying the other one. Nothing changed, but the future expected returns of your portfolio and how your portfolio is going to perform over the next year might change a lot. So that's what we always have to focus about, the future that is yet to come. And that's why it's so hard for people to buy these lows, because if you buy here, it's just the market is saying you're an idiot, you're an idiot, you're an idiot. But we're not after looking right all the time. That is impossible. That's a fool's errand. Meaning that, if you're into that, which most are, that means you're going to be a market timer. You do not. The biggest negative thing people, what they fear most is that something they own is going to go down tomorrow. That's why they're bottom timing. That's literally it. People don't dare to buy something which they think will bring them pain tomorrow. That's why people don't catch falling knives. That's why everybody wants to buy an uptrend, not a downtrend, and why I keep catching falling knives all the time. But the important thing is that that's not even what it's all about. You shouldn't catch every falling knife. It's just, what price am I paying today? What's going to happen over the next 1 to 2 years? If something has gone up 100% already, that means there's a much narrower gap between price at that point to what you expect it to be worth in 2 years than something that went down 50% and the case is intact to what that will be worth in the future. So again, my point is again that price volatility is how you beat this sector. That is the currency. That is why the opportunities change on a daily basis, because price tends to change on a daily basis. And unlike most who think the case gets better when price goes up and the price to future value goes down, meaning you're expected to make less in Minor and Gold from 29 cents to whatever it's trading at in a year from now than you would before it went up 65%. Again, assuming the case didn't change, the geology didn't change, it's just you paid more for those assets. More was priced in, more upside suddenly got priced in. So you have less returns. It's like Bear Creek mining. Do you expect to make more from this point or from this point in Bear Creek going out 2 years? Assuming nothing has changed. I would say this is a way worse buy than this. But most people do not agree with that. They want to buy what is already up. They get taken advantage of by the volatility. And at the same time, if some of these cases are super cheap, it's like, okay, Magna mining, for example. I don't remember exactly when I put out the piece. It's up from there. I think it's up, let's say, 50 to 100%. But I think the price to value gap is so big in Magna mining, especially price to future value gap, that even after it went up 50 to 100%, I still think it might be the best risk reward junior I know of. So it doesn't mean, again, you should not only look at if something goes up, you should immediately sell, or if something goes down, you should immediately buy. No, we every case has a specific, unique risk reward profile. If I thought Magna Mining is for sure worth 300 million easy, let's say, uh, if that's the fair value, fair risk reward value, if it's at 50 cents, that's obviously an even better opportunity than at 70 cents. But 70 cents to $2, let's say, that's still a huge gap. So unless I find something that is material or even better than the, in my opinion, very probable price to value discrepancy of Magna Mining, that would still be the best case even after it's gone up. So that's why I hate when people use rules like always sell on a double, or don't forget to take your profits, or let your winners run. Everything depends. And again, it's like take Snowline Gold. Yes, it's up near all-time highs. Should you sell because it's gone higher? No, if you sell, I think you should sell because you think that the expected returns from this all-time high to what the value will be in 1 to 2 years has decreased so much that there are other better risk reward cases. And honestly, like for a hodler, which I think is the best way to go about this sector typically, especially if it's in that case, hodl means it's got to be a probable grower, good skin in the game, etc. A Bear Creek Mining has typically not been a good hodl story, as you can see. It's a trading sardine. But down here, beta, peak merit of beta, I've talked about this. What has gone up the most since the bottom here? Beta has gone up the most. Up here, that's more for that's when stock picking really becomes important, because if you have if you hold an overvalued stock here, which is not expected to create any value over the next 1 to 2 years, that it will go down a lot is just a matter of time. But if you have a stock here that still has a very bright future, and you think, hey, I think these guys can double their value in the next year, let's say. Even if we go into a sentiment low, so the success gets cut in half in terms of what the Mr. Market will value it at. If that increases 100% in value, you're basically back to a neutral price action or close to that in that case. And still, that would be outperformance, because most of this sector is made up of trading sardines, which will go down 70 to 80%. So if you have again something that's created a lot of value, sentiment is poor, but you're down 30%, but you can again buy beta at 80% cheaper levels than up here. Then you can get into beta again, get that nice revaluation, and then you can more focus on alpha. That's what right now I don't particularly like pre-discovery plays that much. But with that said, I know when we get up to this time here, that's when potential is going to be worth a lot again. That's when we're going to see juniors ramping into assay results. More than, there are some that are doing that right now. But this is when the sentiment is hot and everybody's thinking about blue sky, pricing in blue sky. That's really when you want to, you can use that. Again, front run just, okay, if assay results will come out in, 1-2 months and everybody wants to get rich tomorrow, you can ride that assay hype and sell before and the actual assays are out. So you ride that real hype and let go of that. Now you can't really do that because nobody cares about potential. Everybody cares about not losing their shirt. So nobody's really greedy right now, but that will change. But there's a time and place for that. Now that tool doesn't work. But okay, to be perfectly frank, you can literally just not care at all about this and just try to pick companies with competent management, insider skin in the game, good growth profile. And I think if you have 10 to 20 companies with like, and you can have, let's say, a major giving a thumbs up. There's a few juniors out there with like tech as shareholders. Brixton has BHP, yada yada yada. I mean, I think you could literally buy 10 or 20 of those right now, go away for 2 years, come back, and you'll have made money, good money, beat the index without doing a single trade. Some will go down, of course, but some might be up 400% and pay for the rest. It's like right now the risk reward is superb in the sector, still very good in many cases. Some have obviously decreased because, again, if price goes up without the value of the company going up, that means the risk reward is decreasing. If you loved Minoran Gold at 20 cents, you should like it much less at 29 cents, for example. So this was for a value investor, this is opportunity to sell, simply because an index just bought up the price. And it's just fascinating that, again, people can see how, I mean, this volatility in this sector is a gold mine if you know how to use it. And don't treat this as, now I want to get into this, and now I want to sell these. No, it should be the other way around. It's negative volatility increases risk reward if nothing is changed for the case. Positive volatility decreases the risk reward if nothing is changed. And that's also why you can have a company come out with superb drill results or good news. Stock goes up 30%. Maybe it should have gone up 100%. So that's still a 70% price to value gap that materialized. So I don't really care. Again, I don't have any firm rules like never buy an up day, or I'm never chasing a stock. No, that's a mistake in my opinion. That's too rigid thinking. What does the news mean? It's like Eskay mining recently. I mean, overall, let's say poor drill results, but that hole that hit 45 gram meter intercepts 800 meters from where they have been drilling before. I mean, if you think about the strike over 800 meters, and there's a bunch of targets out there. Okay, price got slaughtered. I saw that as an opportunity. I bought some more Eskay mining. Does that guarantee I'll get a multi-bagger from those purchases? No, but the risk reward was more favorable in my opinion, long-term risk reward, because if they do end finding something substantial or proving up something substantial, obviously I'll probably make more money from a market cap of 130 million than from 200 million. The risk reward doesn't say anything about guarantees. It's just that, hey, there's more upside here all of a sudden in case they strike it really big, and I think it got priced too cheaply. And it's like Novo Resources. That's the opposite version of this here. They got thrown out of the GDXJ. And we know that, what's the name of the company? Some lithium company, just a few days ago, invested at 39 cents per share. And GDXJ, throwing out Novo, sold it down to 2.35. So you have a company saying, hey, this is a buy at 39 cents. GDX sold, simply because of, bureaucracy, etc. It went down to 23.5 cents. That is ridiculous, in my opinion. So that was an opportunity. Again, this was, in my opinion, an opportunity to sell because nothing changed for the better yet, but price went up. So you got some gains, which means lower future gains. In Novo's case, I think the price went too cheap because of the negative volatility from the GDXJ rebalancing. That you get price pain now, but higher future expected returns. That's simply it. Again, maybe I'm just throwing it out there, maybe Benor and Gold went from having a 200% future expected return down to 70% future expected returns 1 year at 29 cents, and Novo went from, who knows, 100 to 200%. I'd rather much have an expected return of 200% than 70%, let's say. So again, we have to train ourselves. Volatility is what it's all about. That's what this sector is all about on a short-term basis. Because yes, price changes all the time, and with price changing, risk-reward changes, but not in the way that people view it. People view it as a buy signal if something goes up and becomes more expensive, and a sell signal if something gets cheaper and the future expected returns get higher. So again, just in this slide here alone, there's a humongous opportunities that opened up if you have volatility like this. Absolutely incredible. Some of these ramps might cut the future 1 year returns in half. Some of these sells, I know that these came after, but like pretend that this was just, it didn't go up like this before it went down, might have added 100% future expected returns. But people are totally blind to that in this sector. They have no idea what volatility is. They think it's risk. This is not risk. This is volatility, price changing, while the value of what you own does not. It does not change the geology, it does not change the economics of a deposit, it changes nothing except risk reward on a given day. Yeah, I hope you got something out of this as usual. Consider me biased. Companies I talk about, assume I own them, always. Assume I'm sponsored by all companies I talk about, even though I'm not. But just assume that, do your own due diligence. Assume I might buy or sell shares at any point in time. And that, again, I don't share your profits or your losses. It's up to you, because nobody's going to hold your hand every day forever in your investing career. Your goal is to learn how to fish yourselves, so I don't need to do any copium videos at bottoms, etc. And that you can take with you your entire life. If you get 2% better at investing this year, or let's say you survived and actually bought this recent low, you're already beating 95% of people just from being able to buy down here. It's very, very few that can do that. Very, very few. You're already in an elite club if you can buy this sector at this low, even though it's absurdly obvious you should. So congratulations if you've done that. My opinion right now, I'm not a market timer like always. We might go down to the same. We might go up tomorrow. I have no idea. This is when I think this sector is going to get very pricey again. And in the meantime, if a case is intact, why would I sell something that I think is going to go up 200% in value or 300% in value over the next 2 years? In that case, who cares if gold in the meantime goes down to $1,600 first or up to $2,000? Risks are to the upside anyway, because sooner or later, metal prices go up, especially in this kind of supply-demand picture. And if a company's added 300% in value over the 2-year period, there's a lot of margin of safety there. So if we're in a bull market, it might not go up to 300%, might go up 1,000%. If it's a bad market, maybe you'll be even. And then it goes up, 300-400%. So we're stacking the odds in our favor simply by buying cheap, not caring at all what a stock does in the short term, except for using volatility to rebalance our portfolio, as risk reward can dramatically change on any given day. And always keep in mind, try to fast forward the tape. How is this company going to look like in 1 year with 20 news releases out? How is it going to look like in 2 years with 40 news releases out, etc.? Compare that to what price you're paying today. Ooh, okay, I think there's substantial upside risk over 2-year period, but that also means you have to stick it out. You can't, if you have a case that, take again Magna Mining, they're gonna have a PA out in 3 months. Okay, I think if these nickel prices are if nickel stays here, it's going to be a barn burner PA, I think. Okay, 3 months to wait for, black in black and white on paper. It's like, yeah, okay, Green Hill and Shakespeare's worth, 500 million to $1 billion or whatever. Maybe we'll have a grant out by then. Maybe more assay results. Maybe toll milling in 12 months. Okay, what do I think is gonna? How's the market gonna feel about all that? Is it gonna allow Magna Mining to be priced at 110 million if these nickel prices stay anywhere close to where they are? No, I don't think so. So that means I have no idea when Magna Mining is going to reprice to fair value, but I think it's a matter of when and not if. And those are the best cases, in my opinion, whereas a pre-discovery play is a big, big if. Because if they don't make a discovery, which is very rare, it's probably going to get cut in half, and then there is no when, because they might have killed the project. I don't like that, especially right now, when banked success is so cheap. Thanks for listening. Have a great day. Bye.